In our last guide, we talked about Dow theory and some broad ways in which markets move. But of course, this isn't the whole story of technical analysis. In this guide, we'll dive into reading more specific types of charts and movements. First up, one of the most prolific types of chart out there, the Japanese candlestick chart. Here's what they look like. Chances are you've seen them before. Each candlestick represents how the price has moved over a given period of time. So, off the top, a green stick means the price has moved up, a red stick means the price has moved down. Perfect. This part here, the body of the candle, shows you the difference between the opening and closing price of that time period. The shadows at the ends show you the highest or lowest point the price has gone over the course of that period. So how can we use these to understand assets? One of the major ways is with trend lines. Trend lines help us to confirm and identify the types of trends we talked about last video. A trend line is an upward or downward straight line that intersects at least two price points. At a base level, this probably sounds silly because you could essentially draw a line anywhere, so let's qualify this a bit further. A strong trend line should, ideally, cross as many different points as it can. As a general rule, a trend line should go through 2 points and have at least a third point to help validate it. The spacing of these points is also important. If the points are really close together, you're looking at such a small window of time that it's impossible to confirm a trend. Conversely, if the points are too far apart, it's hard to say that the points have anything to do with each other. Finally, you should look at the angle of any line you're drawing. A very steep line in either direction is unlikely to be a trend. It's simply not sustainable for an asset to consistently rise or drop 30 to 40% day over day for an extended period of time. Alternatively, a line that's too close to horizontal is basically a support or resistance line that we talked about last video, not a trend. So what do these trend lines allow you to do? At their best, they can help you observe how an asset is moving and where it may go next. Their biggest disadvantage is that it's easy to draw trend lines on almost any chart. So you have to be able to recognize bad trend lines like we described, and be conscious when you draw your own that they are just a tool. No system or analysis is the be-all end-all of where a market will go. Like we said last time, these tools can help you understand why markets move the way they do. They are not foolproof schemes for price predictions. Simple moving averages are another, more mathematical way to try and identify trends. A moving average is calculated by averaging a certain number of past data points. When you plot the moving average, you can see a smoothed out version of the data that is far less disjointed and fluctuating. The math looks like this, where A is the closing price of the asset at the end of a given time period, and N is the period over which it was calculated. So, if over the last 10 days your price looked like this, we can sub it into the math as such, which gives us an SMA of 5.4. So if you wanted to calculate and plot this data, you would continue to calculate 10-day chunks and place them on the chart. As we stated earlier, the result you can see is a highly simplified look at price movements, with much clearer trends. When we relate this to the 3 major movements of Dow theory, people usually use an SMA over 200 days to look for long-term trends, 50 for medium-term, and 20 for short-term. One way we can extend the data given to us by an SMA is with the Bollinger Band. Bollinger Bands essentially take the SMA that you calculated above, but then also plots a positive standard deviation above and negative standard deviation below each point, creating a range for each bit of data. A standard deviation is just a measurement of how much variance can be present in any data calculation. This is very common with statistics and finance. Each point in your SMA will have a band above and below it that indicates how much that average price has moved from its average in that time frame. When the band is very wide from the main data point, that means the asset is in a period of high volatility. It's taking huge up or down price swings that deviate greatly from the past average. As you might expect, when bands tighten around the average points, you're in a period of low volatility. You can typically expect smaller price movements in these periods. Bollinger Bands are a tool that can be used with an SMA to try and identify how much price volatility can be expected at a given time. And that's it for our 2-part guide on reading crypto charts. Remember, none of these tools on their own are any kind of golden ticket. Each one simply gives you a different lens to observe the movement of markets. When used in conjunction with each other, you can start to identify trends and get a better understanding of how assets behave under certain market conditions. Thanks for watching.